Give us a sense here as to why you think the Fed will feel compelled not only to cut once, but to do it again before we get to 2025.
Yes, good afternoon. Thanks for having me. Well, look, we got very good CPI data yesterday, as well as some producer price data this morning that suggested inflation in June actually moderated more than expected. We think this is going to help the Fed gain more confidence that, in fact, inflation is on its way back to the 2% target. So we think that with that increased confidence, and this is amid also a labor market that shows some moderation, that shows some slight cooling as well. We think that with that, the Fed is going to be confident that they are on track, in fact, for inflation to go back to 2%, and that allows them to start cutting rates in September, but then to continue with this rate cutting cycle in December as well. So we added one cut to our call, as you pointed out.
This gets to a kind of a core question that I think has been bounced around for a while, and I know Powell has been asked about this, and that is whether or not financial conditions are indeed restrictive. He was asked that question in the past and said he didn't think they were necessarily restrictive enough here to justify two rate cuts in the span of basically what would be about 3 to 4 months. You would have to assume that their stance on the restrictiveness has changed.
Yes, that's right. So that's a very tricky question. So if you look at the policy rates where they are compared to history, I mean, they look pretty elevated. And I think the Fed officials have repeated over and over again that they thought that policy was quite restrictive. And in fact, Chair Powell has repeated this quite a bit. The evidence for that is very difficult to find, but the part that Chair Powell has alluded to is looking at labor demand, looking at job openings gradually coming down, signs of labor demand normalizing. And I think there's truth to that. I mean, the labor market as a whole is no longer as overheated as it was. It looks like now it's pretty much at full employment. And that's in part due to the elevated rates we've had. Now, the issue, though, is if you look at broader financial conditions, it becomes a little more tricky. And, we track various measures of financial conditions, and one that the Fed has been emphasizing in particular over the past year, in technical term called FCIG measures that the Fed staff has put together, and we update on a very regular basis. And based on that, it doesn't look like Fed financial conditions are particularly tight. In fact, they are close to neutral, if not slightly easy as well.
Okay. You had mentioned that the PPI report was also encouraging. Can you explain how that is to me? Because when I look at the numbers, it looks like everything came in higher than anticipated, whether it's final demand month over month, final demand year over year, or core year over year. Everything came in higher than what economists expected, except for the PPI ex-food, energy, and trade month over month. That was flat. If PPI is a leading indicator for CPI, wouldn't this hotter than expected PPI report suggest the opposite of what the CPI gave us?
No, you're exactly right in describing what happened to the PPI that we got for June earlier this morning. But the way we look at it is we take first the CPI, so the consumer price index that got published yesterday, that showed a very big surprise. I mean, a surprise to the downside, and more importantly, a broad-based weakening in inflation. Then what we look at is the Fed's favorite measure of inflation, and that's the PCE inflation. So consumer prices, but measured slightly differently, that the Fed thinks is more relevant to capture really the inflation that's relevant for consumers. And that involves, I mean, one way to really gauge what these PCE inflation is going to look like when we finally get that release at the end of the month is by looking at the important component of the CPI that we got yesterday, as well as some components of the PPI that we got this morning. And when you put it all together, it looks like PCE inflation, or core PCE inflation, that the Fed is going to be focusing very much on, is going to round around like 0.17% for June in our own estimation.
Okay.
And that involves some subcomponent of the PPI that came in this morning.
Got it. Okay. And of course, that core PC number comes in July 26th before the FOMC decision on July 31st. Yep. So walk me through how you see this September rate cut unfolding. Is the Fed going to start positioning for that at the July 31st meeting, or do they hold off and Powell starts dropping hints at Jackson Hole?
So I think based on the recent inflation data and the PCE inflation that we'll get later this month, as you pointed out, I think the Fed will say in the FOMC statement of the July meeting, I think the Fed will say that they found the inflation data very encouraging. It's that they will also note potentially some increase in the unemployment rate that we've observed in recent months, and with that set the stage for a possible rate cut in September. Then there will be another opportunity for Chair Powell to speak at the Jackson Hole conference in August, so that by the time we get to September, the September meeting, we expect the market expectation to really cement around a rate cut at the September meeting. So that won't come as a surprise by the time we get to the September meeting.